Okay, let's dive into this. So, your bank is definitely using your money. I mean, day in and day out, it's the raw material for their entire business. But the real question, the one we need to ask, is are they paying you what you're actually worth for it?
Just think about it for a second. If you're with one of the big banks, Chase, Bank of America, Wells Fargo, the answer is probably a couple of bucks. Maybe. It might even be just one single dollar. It's kind of shocking when you actually stop and think about it, right? Let's break down why that is. And this slide right here, this lays it all out perfectly. While they're paying you a measly 0.01% interest, which, yeah, works out to $1 on 10 grand, they're turning right around and lending that exact same money out for car loans, for mortgages, for credit card debt at rates from 7% all the way up to 22%. You see that massive gap, that spread? That's how they make billions. They're borrowing from you for free and profiting a lot.
So, you might be wondering, how is this even legal? Well, it's all based on the fundamental business model of banking. It's a system that, by its very design, kind of works against the average person. So let's pull back the curtain a little bit.
This right here is the core concept. See, when you deposit your money, it doesn't just sit in some vault with your name on it. Nope. The bank is only required to keep a tiny fraction of it on hand. So what about the other 90%? Well, it's immediately loaned out to make them interest income. Your deposit is literally funding someone else's car loan, and the bank is just pocketing the difference.
Right, and here's the kicker. That interest spread we just talked about, that's just the beginning. That's only one way they make money off you. They also make an absolute fortune from a whole bunch of direct fees they charge you, just for the privilege of, accessing and using your own money.
And believe me, those fees add up. On average, you're paying your bank over $300 a year. Let that sink in for a second. You are paying them for the honor of letting them use your money to make thousands of dollars in profit. It's a fantastic deal for them. The thing is, these charges often feel small in the moment, but they create this constant drain on your account. It's the classic death by a thousand cuts, right? Where these small, seemingly insignificant fees just pile up into a major loss over the year.
Okay, first up, the one we all hate, the overdraft fee. If your account goes negative even by a single penny, a lot of banks will just slap you with a $35 charge. Some will even hit you multiple times in the same day. It's brutal. Then you've got the monthly maintenance or service fee, usually around 15 bucks. So many people pay this every single month just out of habit, even though you can often get it waived if you meet certain requirements. That's up to 180 bucks a year just to have an account open. And how about just getting your own cash? If you dare to use an ATM outside your bank's network, you get hit twice. Your bank might charge you $3, and the ATM operator, they'll charge you another $3. That's $6 for one withdrawal. It's basically a tax on your own money. So when you put it all together, an occasional overdraft, that monthly fee, a couple of ATM withdrawals a month, you could easily be paying your bank $4, $5, maybe even $600 a year. It's just a massive hidden expense. Okay, enough of the bad news. Here's the good news. For most of the 20th century, we didn't really have a choice. But today, thanks to the internet, we do. It is time to open up the modern money toolbox and look at these powerful alternatives that can put the profits back where they belong, in your pocket. Now, this is the light bulb moment. Look at how dramatic this difference is. Instead of earning $1 a year on your $10,000, a high-yield savings account, or HYSA, can earn you over $500, and they almost never have fees. I mean, this single switch is one of the easiest financial wins you can get today. It's a no-brainer. And yes, they are perfectly safe. HSAs are usually offered by online banks, and because they don't have physical branches, they pass those savings on to you. They are FDIC insured up to $250,000, just like a traditional bank. The key things to know are that their rates can change, and transfers might take a day or two, which actually makes them perfect for your savings and emergency funds. So, that's our savings tool. But what about for our daily checking and spending? Well, that's where our second tool comes in, the neobank. These are digital-first financial apps built for the modern world, and they're designed from the ground up to get rid of all those annoying fees that traditional banks love. They are fantastic for your main checking account. You get these great mobile apps, cool features like getting your direct deposit early, and best of all, pretty much zero fees. So what's the trade-off? Well, there are no physical branches, and customer service can sometimes be just online chat. And for your main savings, a dedicated HYSA will probably still offer you a better interest rate. Okay, so we've got our tools, a high-yield savings account for savings and a neobank for checking. Now, let's put them together into the ideal banking blueprint that makes your money work for you, not against you.
Let's see how this all comes together. Honestly, the blueprint is this simple. Step 1, get a fee-free checking account. This is going to be your home base where your paycheck lands and your bills get paid. Step 2, open a completely separate HYSA with the highest interest rate you can possibly find. This is for your emergency fund, your big savings goals. And then step 3, this is the most important one. You automate everything.
And this right here is the magic of automation. Your paycheck hits your checking account, and on that very same day, an automatic transfer sends a chunk to your HYSA and maybe another chunk to your investments. You are saving money without ever having to think about it. It's that simple. You can't spend what you never even see in your checking account. Now, there is one more powerful and often overlooked tool that we need to add to our blueprint: the credit union. It's a not-for-profit alternative that can offer some pretty incredible advantages.
Just look at this comparison. Because credit unions are not-for-profit, they're owned by their members, people like you and me, they don't need to squeeze every last dollar for shareholders. And that lets them offer significantly lower interest rates on things like car loans and mortgages, a benefit that can seriously save you thousands.
So, to wrap it up, credit unions offer this fantastic combination of lower loan rates, higher savings rates than the big banks, and just fewer fees all around. They are just as safe with NCUA insurance, which is basically the same thing as the FDIC. They are a phenomenal choice for your primary checking account and any loans you might need.
So why doesn't everybody do this? Well, it really comes down to this one idea. Banks are counting on you to think it's too much of a hassle to switch. They are literally betting that you'll stay put and just keep paying them, all out of sheer inertia.
But here's the thing. Switching takes less time than watching a movie, and it can save you hundreds while earning you hundreds more every single year. Your current system is built for their profit. So the real question is, what's the first small step you'll take today to start building a system that's actually built for yours?